with market domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Warner Brothers Discovery putting Max with the Disney streaming platforms, I think is very positive. Who's stronger than Disney, except for Netflix? So it should be a powerful bundle.
Is AI for real, right? Because we've now had Intel, AMD, and ARM all kind of disappoint, especially with respect to the amount of their revenue coming from AI.
Going into the quarterly reporting period, it's not uncommon to see expectations come down. So you get to a point where positive surprises are nearly a given, okay? So the positive surprise dynamic with Q1 earnings is not a surprise, okay? First point. Second point, though, is that when you look at what's happened with the aggregate consensus expectations for the full year, they haven't changed. Right. Okay, so we call it a beat and hold.
We've got 1 hour to go until the market close, so let's take a look at the major averages sponsored by Tasty Trade. We've got a rally here happening, especially when it comes to the Dow, which is doing the best of the three major averages, up about 307 points right now, about 0.8%. The S&P 500 up about 0.5%, and the Nasdaq up about 1/3%. But again, the Dow, the clear leader here today. Taking a look over at the bond market here, we do have a little bit of a continued pullback in bond yields, which doesn't hurt matters. I wish I could tell you there was a clear narrative today as to why things are higher, some clear news catalyst. There does not seem to be. But again, the underpinning perhaps being that we are seeing that 10-year yield continue to push lower. Also wanted to get a check on crude oil futures, which have been moving as of late. They are up today, but still not back up to $80 a barrel. And if you look at the groups within the S&P 500 and what is on the move here, only tech is in the red and not by much here today. So pretty broad-based rally with real estate, energy, and utilities that have been leading those gains. Real estate, which does tend to be interest rate sensitive, but a part of those gains, as well as Equinix, which is a data center REIT. We're going to talk about that later. That is helping that sector. Looking at those Dow movers, since the Dow is the leader today, we do have some pretty sizable up movers. Home Depot is up by 2.3% here. We've got Amgen up by 2%. We're going to talk about that a little bit more at the close with our Josh Schaefer. But interesting here because, of course, the Nasdaq mostly has been the leader to the up and the downside as of late. So interesting that it is the Dow today. Amazon also stands out. It's a trending ticker today on our platform, up 1.4%. Josh?
Julie, markets moving higher today with the Dow aiming for a 7th straight day of gains here. Our first guest is overweight U.S. equities, suggesting better times are ahead. For more on where investors should be looking, we're bringing in Eric Friedman, CIO at U.S. Bank Asset Management Group. Eric, it is good to have you on the show. So you want to be overweight domestic equities, Eric. Maybe we'll start there. Walk us through why you're constructive on the U.S. stock market, Eric, and where you want to be invested, where you're seeing opportunity.
Yeah, Josh, I think you did a great job, and Julie, in the lead up in terms of why. It's really that broadening out effect that we think is going to take hold as we get deeper into this quarter. So specifically, you're seeing a decent, well-represented consensus, we think, actual increased earnings estimates, which has held. So you're seeing a robust corporate profit picture. You're also seeing some more broad participation by sectors. Again, that graphic you had up earlier, just showing just how widespread, if you will, gains are. That's exactly how we want to play this market. We use weakness in April, both across domestic equities as well as commodities, to add to positions. We think that both corporate earnings will accelerate. We also think that inflation will accelerate as we get deeper into this year. So those are two themes we believe in. The way that we did it was through equal weight S&P. We think that gives you a more balanced approach. It's certainly from a valuation perspective better than going into the general S&P from a straight market cap weighting perspective. So equal weight we think is the right way to approach it. That broadening out effect we think is going to continue.
How will it continue if indeed, as you said, inflation still accelerates, doesn't just stay where it is, but accelerates from here? You would think that that could spell some bad news for different areas of the market.
Yeah, it's a great point, Julie. I think if you look at the sort of rate of change that we're assuming with inflation, it will be increasing, but not increasing at levels that really cause a significant thwart, if you will, to corporate profit. So we think there's a difference between, let's call it tail risk hedging within commodities, which is when you have, oil prices just rally massively, where you see really out of control inflationary responses. That's not the market that we think we're going to get. We do think that, again, with a lot of inflation data coming in next week, there's a potential for some downward pressure in the very near term, but we do think that's going to pick up as we get deeper into the year. So as long as it doesn't get to a massive acceleration, if you will, we think that owning commodities makes some sense, and still owning stocks alongside commodities is a way for clients to be participating in both phenomenon.
So Eric, you want to be overweight domestic equities. I'm just curious what worries you though, Eric. What are the risks you would call out, the downside risks to your call?
Yeah, a couple things. One would be some pressure in commercial real estate. You mentioned REITs earlier doing well. And Julie, to your point about some of the positives in the fixed income market, there was a decent 30-year bond auction today, and that really has kept the rates, if you will, contained. And that's what you're seeing really bolster, if you will, REITs, also utilities. Utilities also has an AI play, as we all have been talking about. But I think the first issue would be if we see some challenges to fixed income, we see some auctions go the wrong way and interest rates turn higher, that could be a challenge for commercial real estate. The trigger we're using is about 5.25 to 5.5 in the U.S. 10-year Treasury. We're obviously well below that right now. But again, we've been close to breaching that 5% level a couple times. We obviously did breach it in October of last year. So issue number one, Josh, would be commercial real estate. The second would be challenges to liquidity. Again, we had a liquidity drag, not to get too technical, but whether it was what was happening in the Treasury market, whether it was happening with the tapering process from the Fed, that's something that we think will reverse in May. So if we don't see, again, concerns on the liquidity side, that's obviously a good thing for our positions. But if we do see some bumps in the night, if you will, with respect to liquidity, that would be an issue. Last thing I'll say is this. If we start to see some of the broadening participation reverse and we rely back on large cap tech, that for us would be problematic just because, again, we do think that corporate CapEx is still there. We think there's still delivery in terms of corporations spending on big data, AI, as well as cyber. Those trends we think are embedded. If those reverse, we'd have some concerns, but those would be three risks that we have to our current thought process. But again, this is a market where we're sort of short on hubris and long on stops, if you will, making sure that we're taking shots where we have opportunities, but also recognizing that there's a very fluid dynamic in front of us, especially as we get closer to the election.
And speaking of getting closer to the election, something else you guys are doing that I thought was interesting is buying commodities. And again, just like with stocks, you're looking at, I believe, a broad basket of commodities that could rally going into the election. What are some of the dynamics there that could push them higher?
Yeah, I think a couple things. One, and Julie, to your point, we looked really hard at being more discreet within energy-related equities. That's still a sector we like quite a bit. We thought that having more of a broad-based approach to inflation hedging was the right approach. And I think there's a couple things going on. Number one is that, of course, we're seeing, given the human tragedies across the world right now, some supply chain disruption, and that could certainly continue. Again, our hearts are with those affected. That's certainly more important than financial matters. But that's an area that we think will not be resolved, immediately or necessarily quickly. The second thing that you're seeing is actually a broadening out of participation by outside of these borders, if you will. So if you look at what's happening in Europe, if you look at what's happening even in non-Japan Asia, there's some real strength and momentum. Again, everybody knows about China. China is really trying to export their way to growth. They need commodities to make that happen. So that Chinese story, we don't think is going to reverse anytime soon. So if you factor in some broadening participation by Europe, but also some throughput by China, especially liquidity-driven throughput by China, that makes commodities a decent place to have some capital.
Eric, for fixed income investors who are listening right now as well, what would be your guidance?
Yeah, I think a couple of things. One is it's hard to move out beyond the first couple of years of the maturity cycle. We know just psychologically, if you're getting 5.5% on short-term fixed income, it's a tough place to move out of. We actually would still emphasize for those clients who are taxable municipal bonds. It's actually a more normally shaped curve. Typically the longer maturities yield more than the shorter maturities. That's actually not happening within government bonds or within corporate bonds, but within municipal bonds across most of this country, that is happening. So we'd actually be extending duration, buying longer maturities within munis, but still hanging out more market weight, if you will, within tax exempt bonds. So those are elements that we think will be persistent. So we wouldn't give up on fixed income. We actually really like credit as well. That's a space that we think has been underappreciated. Again, a lot of emphasis on the front end of the government curve, which is appropriate, but we think corporate credit is a great place to be right now. You're getting some incremental yield. Default rates are very, very low. And again, that's a spot that we think, with broadening participation in earnings, that obviously helps bondholders as well. So those are very, very important areas for us with clients in the current environment.
Lots of ideas for investors. Eric Friedman, thank you so much. Appreciate it.
Thanks so much. Great to be here.
We're just getting started here on Market Domination. Coming up, we've got interviews with Robinhood CEO Vlad Tenev and Affirm CEO Max Levchin later on in the hour. Plus, in our investor playbook, we're assessing the state of streaming. Who is best positioned? Who's better left behind? All that and more when Market Domination returns.
Big quarter out of Robinhood. Record revenues, they were up 40% year over year. Crypto revenue up 232%. Lots going on at this company. Let's welcome in Robinhood co-founder and CEO Vlad Tenev. Vlad, always great to get some time with you. Hang with me here on this one. I recently caught up with Reddit's co-founder and CEO, Steve Huffman. And I asked him, it sounded like after his quarter, the platform looked and felt like it's grown up. I'll put the same question to you, just given the gains and the numbers in this quarter. Is Robinhood all grown up now, and investors need to think about your company and your platform a lot differently?
Well, thanks for having me, by the way. I think certainly the platform's become more diversified. We've said for a long time that we don't want to help our customers with their investing activities. We don't want to just do that, but we can help in lots of ways. High yield savings, retirement, the new credit card offering. So you're beginning to see the strategy evolving, and over time, you'll continue to see more products from Robinhood with the core essence of superior economics and superior user experience.
I think the real highlight for me, and we'll dive into a lot of numbers, Vlad, but customers transferred $4 billion in retirement assets to Robinhood. And I know you give rewards or boosters to get some of those assets, but that's a very large number. Why do you think people outside of those incentives, why do you think they're moving the assets to Robinhood? And what are you doing to, I guess, keep those numbers like that coming?
Yeah, and one thing that we mentioned in earnings is it's not just the aggregate level of asset inflows, but also the fact that for the second quarter in a row, we're seeing net positive inflows from all of our major incumbent competitors. So across our incumbent competitors, people are moving more assets into Robinhood than moving out. And I think it's a couple of things. When we talk to customers, particularly for our retirement product, they love the user experience. And the 3% match that is evergreen for contributions is just among the most compelling offers they've seen. A lot of them don't have 401ks through employers. The ones that do sometimes don't have employers that match. So having Robinhood provide that service in an individual self-directed retirement product is really compelling. So it's those two things I mentioned: superior economics, superior user experience.
Do you have an age group? These folks moving retirement assets, is it folks like me over the age of 40 that are making these moves now? Or do you have just retirees saying, I don't know what some of these other retirement platforms are doing, but I like what Robinhood is offering me?
Yeah, I think with this offer, it appeals both to first-time investors, millennials and Gen Z, and there's a long-term trend of each successive generation being interested in retirement and starting to think about it at younger and younger ages. So for example, Gen Z, there was a recent survey that says they start thinking about it when they're 19 years old. And so it's compelling as a first retirement product, but also with the matches, it's also very compelling with someone that has a very large pre-existing IRA account at another broker. And we've seen lots of customers who are maybe 5 years away from retirement age, who the economics of the offer are irresistible to pass up. And maybe they already use Robinhood and they like the user experience for the active trading products or the taxable account. And we've seen lots of transfers with much larger account balances. And I think to us, that shows that Robinhood has evolved in feature set and capability far beyond where we started. And now it actually can serve customers who have more complex financial needs. And that was the goal from the very beginning. We wanted to start with something very simple and evolve the feature set and the capability to encompass customers that have varied and more complex needs. We're starting to see that work, and we're going to continue on that journey in the years ahead.
No, it's fascinating to see. And then also another good quarter in the just the bread and butter of that stocks business for Robinhood. Do you think there's an economic read in there? And by that I mean, Vlad, people are trading more on the platform, perhaps because they're not beating inflation. You know, they're having trouble paying for their everyday needs. Do you think they're now investing in stocks as a way to try to go out there and beat inflation?
I think that typically what you see, and we did actually see this, when interest rates go up relative to relative to cash, stocks become less attractive, and you see flows on a macro level away from the equity markets and into bonds, as well as high yield instruments like the Robinhood Gold product. But you have countervailing forces to that. You have what's happening in the crypto markets. You have a tremendous amount of innovation concentrated in the US in artificial intelligence. And younger customers who typically have a longer time horizon tend to be more optimistic about technology, and they want to be early onto these trends. And so that's balanced out some of the effects that we'd normally see in a higher interest rate environment.
On the trading front, perhaps you could just detail a little more on this Wells notice that Robinhood received on the crypto front. Any update there, and how do you plan to defend the company?
Well, we shared some statements on that. I had a statement on X a couple of days ago. We have been trying to work with the SEC in good faith to register a special purpose broker-dealer to trade crypto assets. Obviously, that process was not reciprocated, and that's unfortunate. We do believe we have the most compliant and safest crypto platform out there for customers. We're, as you probably know, extremely selective about the coins that we offer on the platform. They go through a rigorous vetting process. So it appears that the SEC is taking a hostile posture towards the crypto industry in general in the US. And I think with us, we're eager to defend the company and the industry and our customers. And I do believe over the long run that crypto is going to be an important asset class for US consumers. You've seen jurisdictions outside, in the European Union, for example, taken a much more proactive route where there is more and more regulatory clarity. So, we want to make sure America is not left behind here. We should be at the forefront of innovation across all new technologies. And I think it's incumbent on us to lead that and make sure that the conditions in the US remain favorable to technology and innovation.
Do you ever think that regulators will warm up to crypto?
I do think they will. I think you're starting to see it. I mean, it's been a little bit slower than we would like. But 5 years ago, Bitcoin was in a uncertain environment. Now you're seeing regulators moving past Bitcoin and starting to investigate other things and to try to understand them. I do believe over the long run, the U.S. will get there, and it's just about accelerating that. But the people want it. It's an asset class that, particularly in a high inflation environment, is attractive. You've seen it being adopted and lots of practical use cases emerging. So I think crypto technology and the assets themselves are going to continue to be an important part of the economy.
Lastly, Vlad, Robinhood's sitting on a ton of cash, $4.7 billion. Any thought of, a potential dividend? Are you going to buy back stock with that?
Well, in the past, we have bought back stock. We bought back about 7% of the outstanding in Q3 of last year from Emergent Fidelity Technologies. We've also enjoyed having the flexibility for opportunistic M&A, and we've been very selective about the companies that we look at and we end up moving forward with. But it's a huge strength for the company to have a fortress balance sheet in all environments.
Fascinating quarter from you guys. We'll leave it there. Robinhood co-founder and CEO Vlad Tenev, thanks for always making time for Yahoo Finance. We appreciate it.
It's always a pleasure. Thank you, Brian.
Thank you.
Time for some of the day's top trending tickers. Roblox on that list. The share's down about 22% after Roblox cut its annual booking forecast. sign consumers are pulling back on spending on the video gaming platform. Bookings sort of help be a forward-looking indicator, if you will. In the second quarter, its bookings forecast also came in short of analyst estimates. At the same time, we are still seeing engagement on the platform, although total hours of engagement also fell short of analyst estimates. 77.7 million daily active users in the first quarter on the Roblox platform.
Yeah, it is Michael Pachter, who we both know, Julie, a long-time respected analyst who's covered the gaming industry for a very long time. He does rate the stock outperform, and it was interesting to tell his clients, he really did think the sell-off was, in his word, kind of overdone today, and he was just looking at different metrics, daily active users, he was pointing out, still growing nicely, hours engaged, growing nicely. He just didn't see, none of the figures he was pointing out looked concerning to him. So there's sort of your bull case, but obviously investors not comforted today.
Well, and just a quick reminder, because somebody reminded me today, not everybody knows what Roblox is. Like, I know what Roblox is because my kids are on it. You know what Roblox is because you work here. But Roblox is sort of a gaming platform that has tens of millions of games on it, actually, although only a handful are the most popular. And it's mostly sort of young teenage to upper teenage kids who are playing on here. They can chat within the games, et cetera. They're sort of more rudimentary graphics, if you will. And they're very popular, but there have been questions about the sustainability of demand and engagement.
Yeah, investors have questions today,
yeah,
for sure.
Exactly.
Moving on, ARM shares under pressure despite beating fourth quarter earnings and revenue expectations. The chip design company posting kind of lukewarm full year revenue forecast. And that does seem to be the issue, Julie, the forecast for that fiscal year. And ARM, of course, very synonymous with smartphones, but we know CEO Rene Haas is kind of pushing them harder into new markets like data center hardware. I know some analysts saying, listen, it is, though, that narrow miss on 2025 sales guidance, just not good. Investors who had obviously very high expectations rolling into that print.
Yeah, Mark Lopez is over at Evercore ISI, who has an outperform rating on the stock. I thought he had an interesting perspective on this in his note. He said it's a tough setup. It was a tough setup coming into this because he said with the stock up more than 40% year to date, very much outperforming the S&P 500, and year-over-year revenues peaking in this first quarter, the setup into this print was as challenging as any in our coverage universe. So expectations, the stock had run up, the expectations were relatively high. He still likes the stock, but he says we could still see some consolidation in the near term in the shares.
Yeah, I checked in with John Vinn over at KeyBank, because John is a longtime tech analyst. Telling his clients, here was his take, he's sticking with his overweight rating, in part because he says still opportunities here for outside growth driven by royalty rate expansion from the adoption of ARM v9. And there he's referring to a new version of the company's technology that carries this higher royalty rate. Price target remains 135 for John.
Interesting stuff.
Yeah. Coming up, interesting stuff. Yeah. We'll hear from the CEO of Affirm. Stick around, more market domination after this.
Another strong quarter in the books for Affirm as credit quality, well, that stays stable. Let's get right to Affirm founder and CEO Max Levchin. Max, good to see you here in New York City for a change.
For a change.
Yeah, before we get to the quarter, I follow you avidly on Twitter, and a couple weeks ago you put out this higher for longer rates. You seemed excited about it. Why is that, one, why are you excited about it, and does it benefit a company like Affirm?
It's not a benefit, but I think there is an oft-repeated narrative that it's a huge problem for a firm that the rates are not coming down, and that's just plain inaccurate. Generally speaking, the reason I said higher for longer is a good thing is because that's an outcome of the Fed basically saying, hey, prices are not coming down, inflation is a little sticky, we're going to keep these rates a little higher for a little longer to make sure that the economy cools down just enough. What that means, though, is the joblessness situation, the job claim just came out today, moved up a little bit, but not a ton, still under 4%, reasonably healthy. So long as we are keeping job losses in check, people are able to spend, people are able to transact, people are able to pay their bills, and that's really good for a firm. So higher for longer is an outcome of a not great situation with inflation, but not a terrible thing for us. And as we have proven now over the last couple of years, so long as the rates remain reasonably consistent, we're able to print an excellent quarter, just like we showed yesterday.
What are you seeing in terms of charge-offs?
Still quite stable. You saw that they ticked up a little bit, but all within the ranges of very, very reasonable delinquencies. 30 plus is what we report to the street as kind of the forward-looking metric. Down a tiny bit, but again, very reasonable. We expect some seasonality coming through the summer, typically a slight increase in rates, but generally speaking, our consumer is still borrowing, spending, paying us back. Never a so go to sleep and don't look at it again sort of situation at Affirm. We look at it all the time. At any given day, there's always something to look at and obsess over, but so far so good.
I know you're not an economist, but you have a great insight into the health of the economy. And look, we see consumer sentiment readings. They're not great. People are pissed off about inflation. What's your read on the economy?
Again, I think there's a lot of people who have read the news and said, well, the economy's not doing so hot. In reality, price of eggs is up a lot. Some other prices are not up. In fact, they're down. It's averaging to a number that's not the 2% target that the Fed had set for itself, but it's not exactly at 9 points where we were looking, a year or whatever ago. And so I think generally speaking, the economy is actually in a better shape than the popular opinion will have you believe. I think some of the complaints you're hearing is actually from the upper echelons of income. If you look at the wage growth, I think the lower income groups have kept up better than the higher income groups. And so I think it's a little bit distributed. But from where we sit, people are spending, people are still traveling, which is an important growth vector over the last 12 months. People are still buying nice things for themselves, which is good. We're helping them finance it. And again, they're able to pay their bills back on time to us.
Doesn't sound like an economy that needs a rate cut.
That's where I stop at The Economist. Like, not for me to opine where and when to have rate cuts. What I do know is that we don't require a rate cut to be successful. Again, another great quarter just yesterday, and looking forward to the rest of the fiscal year for us in fiscal 25. Higher for longer is okay.
I want to read this headline for you because I think you'll appreciate it or have something to say on it. Phantom debt from buy now, pay later schemes is a $700 billion black hole that economists aren't accounting for.
That is what they technically call clickbait. That math is so wrong, it's worth doing it on air.
What is phantom debt?
Well, the claim is, not mine, and erroneous as it may be, is that buy now, pay later is this thing that is existing in the shadows of the economy. It's not reported to the credit bureaus, and by year 21,000, it will reach some obscene number. And all of it is wrong. First of all, monthly installments, which is part of the overall buy now, pay later system, has been reported to the credit bureaus, and it's been reported for a very long time. So that's just not a thing at all. So whatever indebtedness you see in the consumer land, it is visible in the credit bureau data. Part one. Part two, there's a fraction of buy now, pay later industry called pay in 4. Sometimes people call it split pay, sometimes they just call it BNPL, but that's the pay over 6 weeks, and weighted average life of that loan is 3 weeks. That means money turns 17 times a year. Last year's overall industry estimate for the US was $50 billion. That's $3 billion in outstanding balances. Total US credit card debt, $1,100 billion or 1.1 trillion. That's 30 basis points. 30 basis points of debt that is not revolving, not generally speaking compounding, doesn't even pay interest 90+% of the time, is not reported to the bureaus. That's phantom debt. You're terrified of 30 basis points of US consumer debt. That is just a headline that's made up to get people riled up and click on headlines.
Do you think that people are paying your bill first as compared to a credit card company?
There's a great question. I think they are paying our bills in a very predictable fashion, because whenever they agree to use Affirm, they see not just, well, here's your bill, please make a minimum payment, don't worry about the long term. So the buy now, pay never, which is what credit cards are, or buy now, pay forever is probably a better term, is a stark difference to what we do. We present the entire plan, you know exactly when your next payment is due. Generally speaking, it's quite rigid, which may seem like a problem, but in fact, it's a huge benefit. Consumers love the sense of control where this is the bill, I gotta pay it. Of course, if you need to have a little bit more time to pay later, slightly later, we will accommodate you, and there are no incremental fees or compounding interest. That is what gets us into this great zone where people, generally speaking, pay our bills just fine. Some people prefer to have their Affirm in the best standing possible, and so I think they do prefer us to their credit card bills. Some, I think, just paying their bills on time. As you saw, 2.3% delinquencies, 30 plus last quarter suggests that they are paying our bills.
Good thing.
Good thing.
Well, you and I have talked, in the couple minutes we have left, you and I have talked in the past about AI, and I can never tell if you're like, man, I can't believe this guy's asking me this about this again. Everybody in my life asks me about this, but let me ask you from this perspective. Since we have last talked, we are Warren Buffett out here at his annual shareholder meeting talking about the genie is now in the bottle. Apparently some weird video of him was posted and it wasn't actually him. Is he right to be that concerned about AI? And I should note too, yes, you're the founder and CEO of Affirm, but you've spent many years in tech industry, and of course we're there for those early days of PayPal.
Mm-hmm. So I think, generally speaking, I am an extreme techno-optimist. And so asking me, should we be worried about some amazing technological breakthrough, that's another form of clickbait. Like, no, we should not be. We should be excited about all the opportunities. We're going to make amazing things, efficiencies, assistants, co-pilots, all of that is coming. Most of it is not ready for prime time. That important thing to be worried about is how far have these valuations run ahead of themselves. There's some amazing things happening, most of them in labs. That said, we announced in our last quarter, as it happens, that we have for a long time now been experimenting with AI as a customer service agent. We still guarantee that any human who wants to talk to a human will be able to do so. But we found that our ability to satisfy consumer requests, questions, complaints, whatever it is they have, with a chatbot that is powered entirely by our built AI is really, really strong. 60% of the time, a little bit higher now, the consumer says, oh, okay, great, that works for me. I don't need to talk to a human. Lots and lots of Gen Zers and millennials like chatting, don't like talking to humans. They get their satisfaction through a chatbot that is AI powered. Very cool. They need to say, hey, I gotta talk to a person, you don't get me.
I still need to talk to a person. I guess I'm the old guy now.
You're the one mashing the button like, operator, operator.
Yeah, okay.
We will always have that. We'll always support that modality of interaction. But a lot of people get their questions, simple ones anyway, done very quickly with a single interaction with an AI.
All right, well, I promise not to ask you about that until, I don't know, a couple months from now when we talk again. Max Levchin, founder and CEO of Affirm, always good to see you. Appreciate it.
Good to be here.
Some more trending tickers for you now, including shares of Duolingo. Those shares down 18% today. Now, despite a strong first quarter earnings report, the company's stock taking a hit after it reported it had gained new users at a slower rate than in previous quarters. Duolingo, an interesting one because, Josh, the shares, it's not like they were ripping going into this. They were up about 8% year to date going into today. The shares are still much higher than they were. I look back to the IPO, which was just in 2021. They went public at 102 a share, and they're trading at 200. So not too shabby on that front. But it is interesting that investors and traders zeroed in on this one metric that did show slowing.
Yeah, because to your point, you look at the report, I mean, Q1 EPS beat. Company raised its revenue outlook for the year, but yeah, it is DAUs, it's daily active users. They did jump more than 50%, Julie, 31.4 million. I was reading that was more than double what it was just 18 months ago, but it did only just beat out consensus. Street was closer to 31.1 million. CEO talked about how he said, hey, listen, we had like 10 quarters of accelerating DAU growth, he said, and we kept saying almost every quarter this can't happen forever.
I love that comment.
Yeah, right. But that is, to your point, what investors seem to be focused on.
Right. You can't. Trees don't grow to the sky, as the old
right.
stock market adage goes.
Moving on, Equinix shares trending up. I'm saying Equinix, not Equinox,
Correct.
Julie.
Yes.
They are trading up as the AI boom ripples into the real estate market. Company reporting better than expected first quarter earnings yesterday, largely due to its data center ownership. So Equinix, this is an interesting one. There had been some talk, Julie, about their reporting time frame, and analysts were talking. There was various kind of different cross currents here. Internal audit committee, DOJ subpoena that we heard about in March. There was that short report from Hindenburg that also came out late March. Bottom line, they did report in what I saw described as sort of mixed results, actually.
But the fact that they reported it all seems to be a relief because of the background that you're talking about. The fact that there had been what was perceived as a delay, that there's all this sort of noise around it. And the company did an internal investigation of its accounting practices, and that's now done. However, there are still some investigations, some questioning into the company from official regulators, federal regulators. That doesn't seem to be complete, but this step that the company did itself seems to have made some progress, and it looks like a bit of a relief rally, really, is what we're seeing in the shares today.
Yeah, team at KeyBank, they're sector weight. Q1 results, they said, updated guidance, completion of the investigation. They call it a positive city, which is a buy on the name, sticking with it. It looks like they say this is a long-term beneficiary, in their opinion, from AI demand. So they're fans.
That would make sense in theory. And then this next one, EPAM Systems. The shares tanking as the company lowered its full year guidance, and the CEO attributed the revision to a challenging demand environment. Now, to take a step back, I had never heard of EPAM Systems, even though this is a stock that had been part of the S&P 500 since December of 2021. So it's been a few years here. It's an IT services company. And, we've been trying to sort of suss out this earnings season. How is the demand for enterprise IT services? And this is yet another sign that maybe it's not fantastic. And there were some analysts who sort of questioned whether the discretionary spend on information technology is going to remain robust this year. And this latest report kind of giving some credence to those questions.
Yeah, that was the bigger question. I think you did see other IT services names. They were I saw some get hit today. It looks like on this Accenture, Cognizant, Grid Dynamics, stock, Globin as well. Stock was down about 40% this year. By the way, trading at its lowest levels in more than 2 years, by the way.
Interesting. Yep. Another interesting for you, sorry. Coming up, the next evolution of the streaming wars is bringing brands together. Find out what it means for investors next on Market Domination.
Warner Brothers Discovery said Thursday it is hopeful for a deal with the NBA after Wall Street Journal report said the company is at risk of losing media rights for the league to competitor NBC Universal. Yahoo Finance's very own Alexander Canal is here with more. Allie.
Yes, and this was a big question mark for investors heading into this earnings report. Warner Brothers Discovery CEO David Zaslav, he didn't give too many details about this, but at the end of his prepared remarks, he did mention the NBA. He said, we've enjoyed a strong partnership with the NBA for almost 4 decades. We're in continuing conversations with them now, and we're hopeful that we'll be able to reach an agreement that makes sense for both sides. He did say that they are able to match third-party offers before the NBA enters into any agreements, and he added that the company is prepared for the variety of potential outcomes that could ensue here, but he would not elaborate on where current talks stand today. And we've been talking about how important the NBA is to Warner Brothers Discovery, especially when you look at their linear networks business, network advertising revenue falling 11% year over year in the quarter. So if you lose the NBA, you lose that bargaining chip. And then you also have to remember some of their upcoming announcements. They have that joint venture with Disney and Fox. That's a sports streaming joint venture that's going to debut this fall. If they lose the NBA, what are they really bringing to that table as well? So a few question marks going on as we think about where the future of the NBA lies, where the future of Warner Brothers Discovery lies. But it's clear that this league is seeking a very high deal. Comcast is reportedly willing to offer more than double what Warner Brothers Discovery currently pays, and they just might not be able to afford it. So a lot of questions, and analysts certainly are looking at any developments here that we can get.
Allie, thanks for staying on top of it for us. Well, what's funny is the future for many of the streaming services might look a lot like the past. Rebundling. An alliance has emerged in the intensifying streaming wars. Disney and Warner Brothers Discovery are teaming up to release a brand new streaming bundle later this year. So what does this new partnership mean for the streaming landscape moving forward? We're looking at how to navigate the big picture with the Yahoo Finance Playbook, and we're joined by Ken Leon, Research Director of Equity Research at CFRA, and Jamie Lumley, Third Bridge Sector Analyst. Jamie, I'm going to start with you. You're here with us in studio. I just keep getting so amused by this discussion because it's like this new innovation, bundling, which is cable, what cable did, right? But do you think that this is the way forward, and is this going to benefit the various parties who are doing it?
It definitely is an interesting development, and we're seeing this increasingly in this space. One thing we've been hearing at Third Bridge from the experts we speak with is just the fact that what streamers are looking for are ways to not only drive growth, but also manage churn. It's a huge issue. Serial churners are one of the things which all these platforms have to deal with, is people either at the end of their show, they decide just to switch to a new platform. At the end of a sports season, they decide to just cut off that service. By having these bundles, it's a new way that they can both drive longer term customer value, while also showcasing different types of content. You know, with the matchup of a Hulu and a Max and a Disney Plus, it really covers all the bases of genres and can appeal to a lot of different audiences.
Ken, I want to bring you here as well. You know, Ken, I heard Rich Greenfield, longtime media analyst at Lightshed, and he said something interesting, Ken. I want to get your take on this, which is that he said he thinks a lot of companies now have a bad case of what he called bundleitis. And I think what Rich was getting at, hopefully I'm not mischaracterizing Rich, but if I am, he'll definitely let me know. I think what Rich was saying was, a lot of companies now seem to believe if I just bundle my services together, that really is sort of the answer to a lot of my problems when it comes to churn or engagement. And I think what Rich was getting at, Ken, is he was kind of disagreeing with that. It really isn't, Rich was saying. Really, you want to answer these questions and these challenges of churn and engagement. Well, the answer to that is great content, but you got to invest in that. What is sort of your reaction to that, Ken?
I think when you look at the bigger picture, it's really a lot of these media companies trying to figure out how can they be profitable. So the first step was reducing programming and content spending. The second was de-risking, because they have no control really of the customer. Unlike wireless or even cable TV decades ago, you had 1 or 2 year contracts. So churn is very high. They will never release that. And also, if you look at where entertainment has moved, to events, to live sports. So none of these managements will say that they can get to a 20% operating margin on this business, nor a 50% EBITDA margin like wireless. So it's not a great business. And I think they're all de-risking, they're reducing capital, and they're going to say, gee, Netflix is a winner, large technology companies can play here. What can we do for two things? One, try to grow subscribers, and two, try to get advertising revenue. So that's where bundle comes in. But it's only going to be maybe a number 3 or 4. There's going to be a lot of players that are really not going to make it in this game because it's just not as attractive as before.
So I guess there's sort of two questions here then. There's which bundle is most compelling to customers, and then which of the individual streaming companies is most compelling to investors, which is maybe those are the same question. I don't know, Ken, but those seem to me to be the two most pertinent questions here.
Well, they are, and they're mostly more U.S. or North America centric. Outside of the U.S., it's a very different game where the average revenue is much lower. And if you don't have an agile technology platform like Netflix, you're way behind, both for trying to get subscribers and keeping them and programming. So when you talk about bundling again, this is a defensive move by these companies, and they're looking to reduce their capital in this business because it's just not as attractive as it was before. For anyone like the CFO of Disney to opine that 3 or 5 years out that this is going to be a great business, they are not showing a case example of the profitability of streaming. It's a very difficult business. It's technology agile, and subscribers can watch House of Dragons on Max and then go somewhere else.
Jamie, I want to bring you back in here because we were talking before Disney reported earnings and we were talking about the streaming business. And your big question, Jamie, correct me if I'm wrong, was really beyond this quarter, really you're looking at a long-term question still about what exactly both growth and profitability looks like for that streaming segment. What's your current thoughts on that?
Well, certainly, if we look at what Disney just reported, they definitely had some key positives in the most recent quarter. They are now at profitability in their entertainment streaming segment, bearing in mind that they have some softer expectations for next quarter. They are roughly on schedule for the profitability metrics they set out when they launched Disney Plus back in 2019. But they're definitely scrambling for growth drivers here. If you look at the subscriber additions they had, there were 6 million core Disney Plus subscribers added. But a lot of that is attributed to the Charter Communications deal, which was set up last year, and there could be some softness going forward. And what was really interesting to see is they cited Netflix as really the example here to follow when it comes to cracking down on password sharing, as really this business is looking for ways to grow, and they increasingly have to be creative to find out what the best way is to tap subscriber growth. Because ultimately, while they are focused on profitability, they still really want to see this be a full transition away from a legacy linear business and be a new, not just barely profitable, but strong, resilient business with strong fundamentals.
So what I'm hearing both of you say is it sounds really hard, what they're both trying to do. So Jamie, I'll start with you, and then Ken, I want to get your take. So who's best positioned then in this streaming landscape? I mean, you guys are both saying Netflix, Netflix, Netflix. Are there other companies that are going to come out of this strong besides Netflix?
Well, Netflix certainly is in a great position. I mean, if we look at them right now, Ken was talking about operating margins. They're at 28%, which is certainly head and shoulders above every other player. And in terms of their ability to catch up, it will take a while, even for those who might be capable of that. It's also worth highlighting Amazon. They're certainly a different platform. They obviously rely on e-commerce for a lot of their business, but increasingly advertising is going to be a huge revenue driver for them. If you look at right now the percentage of Amazon Prime users who are on advertising, it's the vast majority. They'll increasingly be a revenue driver for them, which could make that potentially eventually be a profitable business. Then it's worth remembering that Disney can get there. It's just a question of how long it will take for it to really reach those double-digit operating margins. Everyone, though, below that 100 million subscriber mark, it'll be a tougher story. Warner is kind of there, depending on how you really look at the way they report. But the question really is Paramount going to be able to deliver this, particularly when they're in this time of turmoil, as well as Comcast?
So Ken, same question here, real quick. Who should investors be buying here in this space?
So they should be buying Netflix and also Spotify for music. Investors don't have to own 3 or 5 names in media because the business models are not that good. And I think when you look at growth and algorithms of intelligence for global platforms, it's Netflix and Spotify for music.
All right. You need to Netflix and Spotify. Ken, Jamie, thank you guys both for joining the show. Appreciate it. We are wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
There is the closing bell on Wall Street, and now it's market domination overtime. We are joined by Jared Blickery to get you up to speed on the action from today's session, sponsored by Tasty Trade. So let's start with where the major averages ended up. The Dow ending at the highs of the session here and still leading the gains that we saw, up almost 0.9% or about 331 points here. The S&P 500 up about 0.5%, and the Nasdaq up about 0.25% here. So sort of drift up. I want to check on the S&P Equal Weight Index because we have had a lot of investors in recent days, including Eric Friedman from US Bank at the top of the show, talk about the equal weight and the broadening out of the rally. That theme has been surfacing once again. And indeed, the equal weight index up 0.75%, outperforming the S&P 500, which is market weighted. So just a little tidbit for you to take with you today. I'm sure Jared's got many more tidbits for you. Jared, what are you seeing today?
Well, thank you, Julie. I'll tell you what, I think that's a really interesting observation. And yes, the rally appears to be broadening once again. Here's what happened in sector action today. Real estate number one, utilities number two. And that's been something that's been a common occurrence recently. The two interest rate sensitive sectors that are usually sleepy are leading. In fact, let me show you what's happened this month of May. This is all 7 days. Utilities up 7%. That's the number one sector. Then you have communication services. So just wanted to break off and just kind of highlight that utilities, it's typically not a leading sector, but now it's an AI play because you got to build those data centers. Anyway, here's the Nasdaq 100. You're going to see tech not having the best day. NVIDIA down 1.84%. In fact, let me just skip to the semiconductor heat map. You're going to see more red than green there. Pretty similar story for software, though you see a little bit more green because of Microsoft. And then if you go to unprofitable tech, you actually see the most green. So kind of a little bit backwards here, but nevertheless, in this particular group, we're seeing Robinhood down 3%, Roblox down 22%, both of those earnings stories. And let's take a look at the leaders here. We got cannabis in the forefront, MJ, Harvest ETF up 3.5%. Then you have home builders, Chinese stocks, retail, solar, pretty broad group here that we're looking at in terms of gainers. And let me just show you what's happening with gold miners here. We have seen gold kind of tick up today, and we're seeing a lot of movement in this sector. Not seeing it get a lot of attention, but when gold miners pick up, that's usually a sign that gold is doing something interesting as well. And in fact, it is. Here's gold up 1.24% today, and here's that year-to-date look, up 13.89%, guys.
Thank you, Jared. Stocks closing higher as the Dow extends its winning streak here. Here with some of today's trading takeaways is Yahoo Finance's very own Josh Schaefer. Joshua.
Yeah, we've been talking a little bit about the broadening of the stock market rally here at work again, right? And one of the things that we got today was some softer economic data, which has been a trend over the last month when we think about this broadening. So today we had jobless claims hit its highest level, weekly jobless claims, I should say, since 2023, August 2023. Of course, volatile data set.
Well, and wasn't it apparently that
a lot of people in New York and Indiana, and it might have been
spring breaks?
Yeah, schools
I was notified today that certain contractors for the schools can file for unemployment if there's a break.
So it could have contributed to the it was a big uptick, too. Right. I think that's why we all sort of were caught off guard by it. 20,000 uptick in a week is pretty significant, and jobless claims really hadn't been doing much. But it caught a little bit of attention because we had weaker than expected employment data last week, right, with the April jobs report. So people sort of looking for some signs of cooling. But even zooming outside of just this one jobless claims number that I think we'll get a clearer picture next week because they're weekly. So we can talk about it again next Thursday, right? But zooming out of that, we have just had a little bit of a string of weaker data, not weak data, but weaker than we had, right?
Cooling, not crashing.
Cooling, not crashing data. And what we've seen come with that is yields have fallen, and we've had a little bit more of a broadening out over the last couple of days. I mean, you look at utilities over the last month now, really, even just in May.
Well, you had a good piece on that, Schaefer, which was that I like that piece where you kind of looked at, okay, so what has actually been leading since mid-April? And it was interesting. I mean, it's utilities and staples.
It's utilities and staples. And the interesting thing about that, Josh, was I talked to some strategists about that yesterday, and I said, okay, at a high level, you read that and you think defensive, right? Are people getting defensive here? Or is that sort of the positioning play? And then Keith Lerner over at Truist points out to me and goes, well, maybe it's just they're really cheap. And when you look at the
because they got so beat up.
Because they got so beat up over the last really 2 years. Staples and utilities both two of the worst performing sectors in the S&P 500 over the last 2 years. Also, real estate, which we were just highlighting today, had a great day. Real estate's been awful for 2 years. So there's a little bit of a movement into just some of the stuff that hasn't done well at all, and potentially catch up there.
There's a couple other things to mention with utilities that I think are really interesting. Now, first, and they share this with real estate, both are very interest rate sensitive also, which is part of the reason they've done so terribly. But with utilities, there has been an increasing buzz lately. We've been talking about it a lot around the office, that there is this increasing demand for energy because of data centers. And so even if these companies are not necessarily seeing it in their earnings yet, there are plans to build out more data centers. There's a kind of talk around it. So I wonder if that sentiment-wise, at least, is lending to some of the gains.
It's something that macro strategists have been talking about for, it feels like a couple months now,
Yeah.
slowly pointing it out. Like, look at how much the hyperscalers, so the cloud companies, right, like a Microsoft or Amazon, are spending. Who are they spending to? And a lot of people think it's going to be these energy companies because it takes a lot of energy to operate these GPUs. And so that perhaps benefits utilities. I think for now, right now, a lot of people just aren't sure, how can you really bake that in? How can you price that in? Where is the actual benefit there from a fundamental standpoint? I think it's been a little bit hard to see, but definitely part of the
Constellation Energy, record high today on its earnings.
Utilities.
Utilities.
It's a hot trade.
Yeah. And nuclear power particularly.
And Josh, when you you mentioned the other sector that's been leading since mid-April, Staples. What were analysts saying were the drivers there?
Staples seem like a similar trade in the sense that it's just been a laggard. Because I think when you look across Staples' earnings, there hasn't really been a clear read there into, okay, things are going really well for consumer staples or the consumer right now. That hasn't really been the prevailing take from this earnings season. Of course, we're going to get a lot better look at that perhaps next week. But overall, it seems like when you look at Staples, it just really hasn't done well, again, from a valuation standpoint compared to the S&P. It was entering March at its lowest level in the last couple of years. So perhaps just opportunity for a little bit of a catch-up.
All right, we got one more thing we got to talk to you about, and this is a cool one and an interesting one. The Dow has now rallied for what? 7 straight sessions.
7 straight days.
And you did a little number crunching on what has done the best. And it's maybe a little bit of a surprise over that period.
Amgen.
Look at
is
that.
up 14%. I'm taking a look at the Wi-Fi Interactive right now quickly, and you can see the components in the down. Amgen's up 14%. Apple's your next stock, up 8%. Amazon. So some companies there that are perhaps more common. But Amgen really stuck out to me because something we've talked a lot about with this rally over the last year is momentum trades, right? And you have AI, and you have the weight loss drug trade, and sort of the rise of Eli Lilly even within the S&P 500, and sort of helping push that along with that AI trade. Well, the Dow and the way it's composed, it just isn't always exposed to themes like that. But Amgen comes out last week, and they say they think that that their weight loss drug is going to do well. The testing went well for it. Stock goes up big. And that's the leader over this 7-day run for the Dow, so perhaps entering the weight loss trade.
Yeah, the Dow finally gets a taste.
Yes.
Love it. Good flag, Josh Schaefer. Thank you very much. Well, the Federal Reserve putting the nation's 6 largest banks to the test, but for a new category, climate risk. Here with the latest, Yahoo Finance's Jennifer Schonberger. Hi, Jen. Tell us what we learned.
Hey there, Julie. This just in. The Federal Reserve finding that the nation's 6 largest banks could see 20 to 50% of their real estate loan portfolios impacted by various climate events. Bank of America, Citigroup, Goldman Sachs, JP Morgan, Morgan Stanley, and Wells Fargo were tasked with determining how higher average temperatures, wildfires, and a hurricane in the Northeast, as well as an event of their own choosing, would impact their residential and real estate loan portfolios. The Fed trying to better understand how banks manage these risks so that the Fed can determine overall how climate risks could impact the wider financial system. Here are the major takeaways from the report. Under the most severe climate shock, defined as having no insurance for a climate shock seen once in a 200-year event, that varied from hurricanes to flooding or wildfires. Under that scenario, the 6 largest banks saw 20 to 50% of their commercial and residential real estate loans in the Northeast impacted. Now, key to this report is that banks had a very difficult time trying to model climate risks to assess the impact on their loan portfolios. They noted that there was a lot of uncertainty in terms of trying to model the timing and magnitude of those climate-related risks, which made it very difficult for them to incorporate into their own risk management processes. Also noting in the report that the probability of default estimated on a loan from a climate shock varied significantly across different sectors, regions, and counterparts. Key also to this was that insurance matters greatly. Again, this exercise very exploratory in nature, and it has become a sore spot for Republicans in Congress who have said that this falls outside of the Federal Reserve's scope. Fed Chair Powell said as recently as April 3rd that, quote, policies to address climate change are the business of elected officials, and that we are, quote, not nor do we seek to be climate policymakers. Powell maintains that the central bank has a narrow role that relates to supervising banks when it comes to climate change. Again, guys, this is very exploratory in nature. No penalties here when it comes to capital consequences for banks, unlike the stress tests, which test for severe economic recessions and whether banks would be able to withstand those scenarios. Guys.
Jennifer Schonberger, thank you. Donald Trump reported looking to tap oil executives to contribute $1 billion to his re-election campaign. That's according to the Washington Post. For more on this, let's break to Yahoo Finance's senior columnist, Rick Newman. Rick.
Hey, guys. That's right. Big oil executives were meeting with Donald Trump down at Mar-a-Lago. Now, they didn't say they were willing to take this deal, put in $1 billion into his election campaign and get favorable treatment from the White House. And I think that would be a pretty dumb idea. What Trump doesn't seem to get is basically everybody, including big oil CEOs, acknowledges that climate change is a real thing and that we have to deal with it. So I was just out at the Milken Conference in Los Angeles. There were a lot of panels on energy. The CEOs of Exxon and Chevron were there. And they were discussing, as they have been doing many times before, the plans they have to do their part with dealing with climate change. Now, some of this might be greenwashing. I'm not saying they're at the fore of the movement, but they are getting into things like carbon sequestration, trying to develop lower carbon emission ways to actually extract oil. They realize this is just going to happen. I mean, we're going to have to do this. It's happening all around the world. And I don't think they want to go back to the smokestack days the way Donald Trump does. I mean, in some ways, he's just stuck in the 20th century, drill, baby, drill. Even the oil and gas industry has moved beyond that these days. So it'll be very interesting to see whether they really get behind Trump. I just want to give you guys one more stat here. The oil and gas industry, the energy sector, has actually done way better under Biden than it did under Trump. And I'll just give you the numbers. I just looked these up today. Under Biden, the average profit margin in the energy sector has been 11%. Under Trump, it was basically zero. And if you exclude that wipeout year for the energy sector of 2020, the best you get under Trump is a 4.5% average profit margin. So it's more than double that under Biden. And guess why? They're producing less, the price is higher, and they're simply making more money. So this idea that Trump's going to open up all this drilling and they're somehow going to make more money, I don't think that is even a baseline assumption at this point.
Well, and it's interesting, Rick, because, I had the chance to catch up with Darren Woods, the CEO of Exxon, at CERAWeek and asked him about the IRA specifically. And he said he's in favor of it staying in place. While many of these oil execs might want the LNG export pause or ban to be lifted, they want stability. And corporate America in general seems to want stability. They don't want to have to be whipsawed every 4 or 8 years as the administrations turn over.
They want stability. And guess what else, Julie? They're doing fine. They actually don't need anything from any political administration. And they absolutely want that LNG export pause gone. And here's a prediction. I think it is going to be gone. Even if Biden wins, I think he's going to end it after his reelection, because I think that's just a pretty bald-faced sop to climate activists. And it's not even productive. I mean, we need to be shipping gas around the world. It's a base. We don't have to geek out here, but you need gas even if you have renewable energy. And this is hugely important as an energy security thing because of what Putin's doing in Russia. So The energy companies have figured they are finding their place in the green energy transition. And guess what? They also know the world is going to be needing petroleum and natural gas for the next 50 years easily.
Right.
They're not going to have any problem with demand. The emerging markets are coming online. There's going to be plenty of demand for their products. So there's not a lot else they really need.
Yeah, and they've been increasingly outspoken about that message, by the way. Yep. Rick, you mentioned you were out at Milken in LA. Just give us quickly your big takeaway from that conference.
Well, of course, there was a lot of talk about what the Fed's going to do with interest rates. I'm going to make a call here, guys. Higher for longer is now officially the most overused cliche in the history of finance. I don't think I can stand to listen to another discussion.
There's a lot. I don't know. There's a lot of competition for the most overused cliche in finance.
Well, okay, we'll do that on a different segment. Okay. Financial bigwigs very optimistic about the U.S. economy. I know here in America, a bunch of people might be thinking, "What are they smoking?" Guess what? People who look around the world say the U.S. is just massively outperforming everybody else. People who go around collecting investments from all over the world say everybody is over allocated to the United States. They just want to be here. There was a lot of talk about energy, and there's a lot of money in the green energy transition, and these guys are trying to figure out where it is. And as with everybody else in America, most of the people at the Milken Conference are dissatisfied with their choices in the 2024 election.
Interesting stuff. Thanks a lot, Rick. Appreciate it.
Bye, guys.
On the other side, we'll hear the latest on drug price negotiations with CMS's director of the Center for Medicare. More market domination over time coming up.
Welcome back to Market Domination Overtime. I'm Senior Health Reporter Anjali Khemlani. The Center for Medicare and Medicaid Services just dropped new guidance for their next round of drug price negotiations while already being in the middle of the current batch. Here to join me now to talk about all of it is the CMS Deputy Administrator and Director for the Centers for Medicare, Dr. Meena Seshamani. Dr. Seshamani, thank you so much for joining us today. And really a lot going on. You're already negotiating on one side and you're already pivoting to start the other one. Let's talk about what has changed. What is new in this draft guidance?
Yeah, thank you so much for having me. We are implementing this law in the most thoughtful way possible, which means making sure that we are learning from the first round of negotiations and getting feedback from everybody interested in this process. And so to that theme, there are definitely a few changes in the draft guidance that we just put out for the next cycle of negotiations. One big area is something called the Medicare Transaction Facilitator. We received quite a bit of feedback that people were interested in us playing a role in supporting that negotiated, agreed upon price being made available at the pharmacy to people in the Medicare program. So in this draft guidance, we have proposed a Medicare Transaction Facilitator that would enable the exchange of the data needed between all of the relevant pieces of the supply chain that are involved in providing drugs at the point of sale. And we're also asking for comment on support for payments that will have to go between the manufacturer and pharmacy. We've provided two options in the guidance that we're asking for comment for. Another big area is around how we are getting feedback during the negotiation process. You may know that we had 10 patient-focused listening sessions for the round of negotiations that we're in right now. And we're asking for feedback in the guidance around how those went. Should we be thinking about having a more interactive session, about creating groupings for questions or for types of stakeholders? So we're asking for quite a bit of information there as well.
That's all a lot of leaning towards that transparency side, of course, so important. Talk to me about what are some of the lessons you have personally learned and just generally, the administration through this process that you're setting up for round two?
Yeah, I think you hit the nail on the head, Anjali. I think transparency, continually learning through the process, engaging everyone, making sure that all voices are being heard are very important. We also, in this guidance, we also released our information collection request for feedback, which is what is the data that we are going to be collecting from everyone as part of this process. And we have made some potential changes there as well to clarify the kinds of questions we're asking so that people know what we're asking for. Again, grouping the questions in a way that people can more easily understand. So I think really engaging in that back and forth has been very important as part of this process to make sure that it is thoughtful and it is working as intended to be able to support access to innovation for the therapies that people need.
We're certainly sitting in a different space than the last time you and I spoke. Then you were facing also the litigation from these pharmaceutical companies. Now a few of them have been thrown out, and you're also dealing with the negotiations right now. How has that shifted sort of how these companies are engaging with you, and how are those negotiations going right now?
That's a great question, Anjali. Our priority has been to implement the law in the most thoughtful way possible. So from the beginning, we have engaged with everybody involved. We have put out our guidances, gotten feedback, incorporated that feedback, and when we revise the guidances. And that is the theme that we continue to use. We are implementing as thoughtfully as we can, and we are negotiating on behalf of the millions of people who rely on these medications for their health and well-being, and on behalf of the Medicare program.
At any point in time, did you feel like maybe you underestimated the reaction that the pharmaceutical industry would have, or underestimated how they would go about this process, or the impact that the negotiations would even have on the companies and their stocks?
Well, I think, in fact, you have reported that when we had announced the selective drugs, it did not have an impact on the stock market. I think that was something that you had reported. You know, in all of the conversations that we have had, again, across patient groups, providers, you know, drug manufacturers, health plans, others, everybody has a common goal here of rewarding the kinds of innovations for the cures and therapies that people need and making sure that people can access those treatments. You can have the most wonderful treatments out there to save someone's life or, you know, increase their well-being. But if they can't afford that medication and they leave it behind at the pharmacy counter because of sticker shock, it is not serving anybody, not that person, and not the people who have worked hard to bring that innovation to the table. So, you know, we really are approaching this in a way to try to improve the care that is provided to people, improve health outcomes for our populations, and make sure that the dollar is spent in the smartest way possible.
Certainly something to watch. Meanwhile, quick pivot, Medicare Advantage, that's also another topic of interest right now as we've seen the most recent earnings calls from these insurers. With the rate cuts that you've sort of done for the reimbursement, I know that there's been some concern. Some of the insurers are warning that they might have premium hikes or maybe sort of redesigning these plans and maybe providing fewer benefits for seniors. I wonder if you have any thoughts on that and if that's going to impact at all the upcoming rates that you have planned.
Yeah, we have finalized a 3.7% increase in reimbursements to the Medicare Advantage plans, which is about $16 billion. That increase is greater than the increase that they got last year. Last year it was 3.3%. This year it's 3.7%. And last year, the premiums were stable, the offerings were stable, choice was stable. So we are confident in the stability of the market. And we continue to believe that Medicare Advantage is an important part of the Medicare program and that all parts of the Medicare program need to drive towards transparency, towards access to coverage and care, and towards helping to be good stewards of the Medicare program so that is affordable and sustainable for generations to come.
Definitely we'll be watching that as well. I know there's a lot of focus on what happens for the upcoming year. We'll have to leave it there. Thank you so much, CMS Deputy Administrator and Director of the Centers for Medicare, Dr. Meena Seshmani.
Thank you for having me, Anjali.
Let's recap the action from today's session, sponsored by Tasty Trade. All three major averages in the green, but especially the Dow a standout, and it actually rose for the 7th straight session, up 0.9%. The S&P and the Nasdaq also rising, and as we've been talking about, the S&P equal weight index outperforming the 500 market weight index, another signal that the rally is broadening. The XLU, the utilities group, also rallying for the 7th straight session, by the way, and that highlighting the strength we've seen in utilities that our Josh Schaefer was talking about a little bit earlier today.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. And stay tuned for our latest edition of Lead This Way. It's on the other side.
WorkJam wants to revolutionize the way frontline workers are managed. The workplace management app offers a one-stop shop where workers can view and adjust their schedules, communicate with colleagues, and access learning features. Here to discuss the state of labor and what's next for workplace automation is WorkJam's co-founder and CEO, Stephen Kramer. Thanks for being here.
Thanks for having me today.
So I want to talk about, first of all, sort of zoom out and talk about the big picture state of labor, because we just got jobless claims numbers, for example, this morning in the U.S. that unexpectedly ticked up. So just in terms of sheer numbers, give us an idea of the sort of demand picture right now.
Well, WorkJam is an organization that focuses primarily on the frontline workforce. And although we saw a little bit of softening in the job report, we do continue to see a tight labor market in the frontline space. As an example, particularly in retail, we saw that retail added around 20,000 new jobs compared to 7,000 on average for the last period for the last 12 months. So the job market continues to remain tight. Certainly the numbers eased up a little bit. We also saw some slight easing as well on wage increases. But I think that organizations are very in tune to the front line and particularly their staff and what they need to do in order to retain them and elevate their employee and customer experiences.
And Stephen, what is business like for WorkJam specifically right now? What kind of demand are you seeing? And is the demand, Stephen, coming from certain sectors, certain industries in particular?
Well, WorkJam is a system that basically revolutionizes the way that organizations are managing their frontline staff through communication, flexible scheduling, and operational excellence. And I think that what we're seeing right now is actually very strong demand globally. And the reason why is that organizations are very focused on improving their margins. Certainly over the last years, there's been a lot of pressure on wages. Inflation has also resulted in pressure on their margins as well. So doing more with less is something that is very common in the discussions that we're having with prospects. We're also seeing organizations start to make the link between customer experience and employee experience. We all know that happier employees, more engaged employees lead to a better customer experience, which is more important than ever right now, where customers are very fickle when it comes to the organizations that they're doing business with. And lastly, I think because the market remains tight on the front line, the jobs are more specialized, the need to retain your employees is something that is certainly paramount for our customers and our prospects that we're speaking to. So demand is very high with an appreciation of needing to really revolutionize the way that they are managing this staff.
And Steve, do you feel like, we talk a lot about AI. Do you think, one would think commonsensically that frontline workers are sort of more AI proof, if you will, perhaps than other types of workers? Is that what you see sort of being borne out in discussions with your clients?
Yeah, I think the focus on AI is really interesting, where the amount of insights that our customers are able to gain through the data that we collect through our platform around productivity and engagement levels is being used really to drive operational excellence. There's not really a risk right now around AI replacing frontline workers. We saw that particularly over the last years, there was a lot of focus on self-checkout and what impact that was going to have on the front line. We're seeing a lot of organizations pull back on those plans right now as a result of some challenges that they're having. I think the power of AI is really around driving operational excellence in these organizations and allowing them to operate more efficiently.
Stephen, it's interesting. I think the pandemic highlighted for a lot of people how critical frontline workers are, but also, the challenges facing a lot of these folks. I'm just curious, from your vantage point, did anything sort of change for frontline workers post-pandemic?
For sure. I think that the pandemic was a real black swan event where never in history were people hanging out their their windows applauding, employees that worked at grocery stores. So that gave a lot more emphasis around the need to drive a better experience for the frontline. I think it gave the frontline a little bit more empowerment to have a voice in these organizations, to drive culture, and also the benefits that they have within these companies. Certainly what occurred as a result of the pandemic and coming out of it was a very, very competitive job market. So it also led to organizations implementing strategies like earned wage access and flexible scheduling. Part of what we do, as an example at WorkJam, is we allow employees to work at more than one location. Typically hiring was done at one location. So giving flexibility in the scheduling was a big outcome, actually, of the pandemic, and has remained in place in order to drive retention. And it's important now because the statistics also show that most frontline workers are working 2 to 3 jobs right now as a result of stubborn inflation. So giving more flexibility in their shift schedules also allows you to drive a higher level of loyalty and retention to the organization.
Interesting. Stephen, thank you so much for joining the show today. Appreciate your time.
Thanks for having me. Appreciate it.
On the other side of the break, we're heading into the NFL in the latest episode of Lead This Way. That's next on Yahoo Finance. The NFL needs no introduction, and neither does Troy Vincent, former Philadelphia Eagles cornerback turned NFL insider. As executive vice president of football operations in a league of 32 teams valued at $163 billion, Vincent oversees what's most critical to the game, its rules.
Leadership is lonely. Your compromises of today become your standards of tomorrow.
Behind the business of America's sport, football operations is tasked with monitoring policies on the field to protect players without damaging the popularity of the game. And Vincent is doing it at a time when the NFL's coaching and player development are being questioned, even by former quarterback legend Tom Brady. With the NFL's commercial success and growing fan base, there's a reason why it's often hailed as one of the country's greatest unifiers. But there is no NFL without its nearly 1,700 players and Vincent, committed to the athletes and preserving the integrity of the game. Yahoo Finance met with Vincent at the NFL headquarters in New York City to get a closer look at the challenges and rewards of heading the operations of the world's largest sports league.
So Josh, this is where the Art McNally Game Day Central is where I probably spend during the season 98% of my time.
So this is when I hear Aikman, Joe Buck say,
Anytime
it's in
you
New
hear
York.
any announcer, this play is going back to New York or is being reviewed in New York.
Right in here.
This is what they're talking
Let's go. One thing's for sure, Vincent is not soft about football, even when running new and at times risky policies to a game loved and watched by millions, with one goal in mind, building on the success of the league by investing in its players. You want policies and procedures on the field that are going to protect players, reduce risk. You also, though, you want to maintain the spirit of the game that Americans love, which is, listen, it's the pace, it's the energy, it's the aggression, right? How do you kind of think about balancing those goals?
So I'm in a unique position from my former years as being on the field. And it's preserving the game that Americans and those who are abroad have come to love. They love points. They love the excitement. They love these memorable moments while being responsible of protecting players from unnecessary risk. I come from an era where there were things that we did, that I did personally, things I was taught that really have no place in the game.
Such as what, Troy? What's an example?
Like just using a helmet as a weapon, like trying to really inflict harm to your opponent. That was the mentality.
Before joining the executive team, Vincent got his start in the NFL as a first-round pick in the 1992 draft to play with the Miami Dolphins. As a cornerback, he helped the Dolphins reach the AFC Championship game his rookie year. But Vincent really made his mark when he signed with the Philadelphia Eagles, where he made 5 consecutive Pro Bowls. But as Vincent says, football was a different game in his time.
There was an era of football that we grew to love, self-included, that was just, there was a brutality. It was acceptable. Now with science and engineering and research, we've seen it's really about what does life look like? Because a 21 to 22-year-old has no clue of what life looks like or will feel like at the age of 40, 50, or 60. That's our responsibility as legends, as gatekeepers, to protect that player from unnecessary risk.
As Vincent puts it, encouraging player safety while at the same time maintaining the pace and aggression of the game fans love is a careful balancing act. In 2024, the hip drop tackle was banned after the NFL found injury rates were 25 times higher when a tackler wraps a runner, unweights himself, and traps his opponent's legs. Rule changes have left some fans and players concerned that the game has been watered down and is not as exciting as it used to be. According to Sportsbook Review, 82% of fans believe rules and penalties should be changed.
I think there's a lot of mediocrity in today's NFL.
In 2023, former quarterback Tom Brady didn't hold back on voicing his concerns with the direction of the league.
The rules have allowed a lot of bad habits to get into the actual performance of the game.
I respect Tom, and Tom has earned that right to voice his opinion, like others, and they should challenge us, hold us accountable as gatekeepers. In Tom's era, the majority of the quarterbacks weren't dual threats, pocket passers. When you look at the way the rosters, from your Josh Allens to your Patrick Mahomes, your Lamar Jacksons, your Russell Wilsons, these dual threat quarterbacks, your Justin Fields, these individuals, it's a different era in quarterback play.
In the offseason, Vincent and the NFL Competition Committee assessed what changes need to be made for the next season. And on March 26, NFL owners approved a new rule that is turning what was called a dead play into an integral part of the game again. Kickoffs. As opposed to a traditional running start, the kicker will kick off from his 35-yard line, and the rest of the kicking team will line up at their opponent's 40-yard line. The play begins when the ball is either caught or hits the ground in the landing zone. The goal? Create an exciting play with higher returns while also reducing injuries.
It's the space and speed. It's when the player has the ability, and our players are now, they're running 18 to 22 miles an hour. When they have that space to build up that kind of speed, and then you make the impact, that's not what we want. We all know as fans, when you have an explosive kickoff play, it changes the atmosphere, not only in the stadium, it changes the momentum of the game. We want to bring those elements back. They should be back.
The new kickoff model will give return opportunities to players with big play potential, and the impact was immediate, with the Pittsburgh Steelers signing a 2-year, $6 million contract for Cordarrelle Patterson, who had a record 9 kickoff return touchdowns during the 2023 season. The new rule even influenced draft day decisions, the lifeline for keeping the league fresh and competitive, with Texas A&M's Anaya Smith, Penn State's Daquan Hardy, and University of Texas's Xavier Worthy selected for their speed and return capability. On top of athletic performance, player development and coaching are critical in determining whether a rookie will thrive. And Vincent's work with players isn't just about what happens on the field. Helping them plan for life after football is just as important.
I was always concerned about the challenges of transition. So I had the opportunity to play 15, a sport that we love. Kids game, man's body. And you don't have the time to develop some of those skills that you would get in an internship or that you would get in a normal 9-to-5 job. So from our business entrepreneurship programs, broadcast boot camp, and now we're at a different era, like the game has evolved. Players are now being paid in high school, at the collegiate level. The accessibility to information is at their fingertips. Many more entrepreneurs. Players wanting to own their own media company. So we've had to adjust what the players' interests are based off of where they are. That is something that's dear to my heart personally, is making sure that working with the Players Association, working with the clubs, that we're all in alignment with player transition. The inevitable is going to happen, and oftentimes that transition happens not by your choice. And are you ready, and do you have the skills to transition into what we say the new normal?
Football is even bigger than the game itself. The NFL adds $5 billion to the U.S. economy every year, and the 2024 Super Bowl became the most watched television program in U.S. history. Its dominance is no accident. It's the result of strategic media deals and exclusive sponsorships. Last season alone, the NFL was partnered with 48 brands holding top deals with EA Sports, Nike, and Verizon, while generating over $11 billion from broadcasters including Peacock, Amazon, and ESPN. It's more than just a pastime, it's become a cultural phenomenon, bringing together millions of fans even when the country feels most divided. As Executive Vice President, Vincent says it's a tremendous responsibility to support the league's powerhouse operations, but also a shared one.
We're working together to try to come together to win a football game and create some excitement. And I hope, your lips to God's ears, that the game can continue to be a positive force for just people coming together, cheering for their club, cheering for their favorite players. At the same time, it's a delicate balance, a delicate integration of things that we believe that are important for the player, important for the club, that we come together to try to resolve those things together. It's not always perfect, and there is disruption that occurs. But we understand the platform that the National Football League has on the broader society.
A platform that goes well beyond revenue and profits and taps into the inspiration and drive that not only got Vincent into the league, but got him to where he is today.
I believe everything that I've learned in my current role were attributes and things that I learned in athletics. What you did on Sundays, Mondays, and Thursdays, and how you showed up on game day was a reflection of what you did during the week. If you didn't practice, if you didn't detail your work, if you lacked in on preparation, it showed up on Sunday. It showed up on Monday night and Thursday night. So paying attention to detail, falling in love with the basics every single day following this process prepares you to have success when the lights are on. But going from the playing field to the boardroom, those same skills were natural transitions in the corporate area. Being a good listener, being a good communicator, not trying to be the loudest voice or the most talkative voice in the room, being a collaborator, being a partner, showing up every day. Where I began, I didn't know what a leader was. There was a parallel of on-field performance with literally what the impact you were making on decisions that were not on the field, whether they were in the community or inside the locker room, being a locker room leader around areas of the collective bargaining agreement, hours, wages, working conditions, and player rights, family rights. Now, being mature in my current role, 15 years here now at the National Football League, it's really about people and getting people to believe in what your objectives are, what your goals, and their why. Why is important for them to at least hear what you're saying and buy into moving in that same direction.
Time now for What to Watch Friday, May 10th. Starting off with the Fed, we're getting another round of commentary tomorrow from Fed Presidents Austin Goolsbee and Neil Kashkari, as well as Fed Governor Michelle Bowman and Fed Vice Chair for Supervision Michael Barr. This is coming after yesterday's comments from Boston Fed President Susan Collins, the latest Fed official, to reiterate that rates will likely stay high until inflation is clearly heading towards the Fed's 2% target.
And taking a look at the economy, monthly consumer sentiment data coming out in the morning. Economists forecast that number to tick down slightly, this coming off April's reading, which was also dragged lower as consumers continue to deal with high inflation.
And fresh first quarter earnings from Sweetgreen out today. That stock is trending up after hours on the report, boosting its 2024 outlook amid higher menu prices. CEO Jonathan Naiman will join Yahoo Finance for the morning brief tomorrow at 9 a.m. Eastern Time.
And that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a good night.